most businesses that have, half a million of EBITDA or more are interesting acquisition targets for private equity backed companies, public companies, other folks. And so the entry point for when you might be able to get an investment banker involved or somebody that can sort of actively go manage the sale of your business sort of starts at that lower level. And so that could be, 3, 4, $5 million of revenue. It doesn't have to be a huge business. Now, to be a what we would call a platform business, where a financial buyer, whether it's a family office or private equity firm or whatever, oftentimes for those institutional investors, their starting point will be closer to 2 million of EBITDA or up. And so that creates sort of an exponential amount of opportunities for that business. So they don't have to just sell to a competitor or sell to somebody in their industry or whatever. Now they can be, okay, an investor could come in and say, I'm going to buy a controlling stake in the business and I'm going to invest behind the management team to take this to the next level. And then we're going to make acquisitions and you guys are going to sort of manage those acquisitions. We're going to expand geographically or organically, but you guys are in charge of all that. We're just sort of supercharging it with the capital that we have. So that typical entry point is about 2 million of EBITDA, but businesses vary in what their margin profile is. So we've had clients that are at 2 million of EBITDA that, were 6, 7 million of revenue. And we've had others that, you have to be 20 plus million of revenue to be able to get to 2 million of EBITDA.
Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman. Welcome back to another episode of How to Buy and Sell a Business Successfully. Our goal here is to help all of our listeners have a better experience with their deal process, whether they're buying or whether they're selling. My name is Sam Foreman. I'm the founder of Foreman Law, and I'm excited to be here today. One of the best things going on in my life right now is that my 3-year-old is a exceptionally early riser. He likes to get up at around 5:15 in the morning, and he wants to play superheroes. And he has the most adorable little Spider-Man costume. And guess who gets to be the villain? That's right. It's Dad. I am the baddie, and I love it.
Is it because you're a lawyer?
Fitting. Supervillain lawman. But yeah, and I'm joined today by my co-host, Jacob Wayman.
Yeah, thanks, Sam. My name's Jake Wayman. My wife and I are the owners of Orange Theory Fitness here in town, and also serve as a fractional business development executive. I work with companies like Infinity Capital Partners with Chris here, and then also my family's company, Citywide Facility Solutions. And the funnest thing I'm doing right now is I get to play Mario Kart with my 3.5-year-old on a really old school Wii. That's been so much fun.
Nice.
Every time I get home, he's like, let's go play Mario Kart. And so that's been fun that I get first most times because I love that game. He gets last, but he does not care, and he wants to keep playing and keep playing. So it's a lot of fun right now.
That's awesome. The magic of time with Dad.
Oh yeah, it's fun. It's fun. Well, we're excited today to have Chris Lee, managing partner of Infinity Capital Partners, with us. I won't steal his thunder, so Chris, I'll let you do an introduction of yourself and a little bit of your background, and we'll jump into some questions.
Okay, sounds good. Thanks, guys, for having me on. I'm Chris Lee. I'm one of the co-founders of Infinity Capital Partners. We are a boutique investment banking firm based in Oklahoma City and cover kind of the region, kind of the central part of the Midwest here. We started the business about 8 years ago, and the purpose of starting the investment bank was in Oklahoma City. There was not an investment banking presence, but there was a lot of really good businesses that needed capital to grow or expand, or had a minority partner they wanted to buy out, or wanted to sell the business because they were retiring, things like that. So we were doing some consulting work with a number of these companies, doing contract CFO and other services like that. And we saw this need and saw that there was no sort of local supply of that resource. You really had to go to Dallas or Chicago or New York or one of these sort of money centers to be able to get access to investment banking help. And we had this thesis that, people in this part of the country want to do business locally, And so, we set up, we shut down our consulting business and started Infinity Capital. That was back in 2016. Fast forward to today, we've grown from 2 people to 14 people. We've done 46 transactions in that 8-year span, and about a $1.5 billion of sort of transaction value across that time frame. So definitely proven the thesis that people want to do business locally. And more recently, that's led us to expand the investment bank. We brought on Jake a few months ago to help kind of expand into Wichita. We're actually moving a couple guys out to Tulsa next year and looking at opening up a Tulsa office as well. And so the next several years are kind of regional expansion. But that's kind of a little bit about us. We help companies raise capital. We help them sell. We help them refinance or restructure debt. We help them buy companies if they've never done that before, or if they just don't have the internal bandwidth to do it. And so we'll help with all those services. Really anything capital related we'll help them with. And size of companies typically range from about 2 million of EBITDA up to about 30 million of EBITDA. And that often translates to about 10 million of revenue up to about 200 million of revenue. So that's kind of the background on me and background on Infinity Capital.
That's awesome. Something I do want to highlight on Infinity's culture is a few weeks after I got started with them, he sent me a link and said, "Hey, what Jordans do you want?" And I'm like, "Jordans?" He got me a pair of Jordans, and I was like, "Man, this is how I know I found a good culture when they have a good shoe game." And that was awesome for that. So that's just some little tidbit on the culture that they have there, but it's a cool group. But kind of jumping into investment banking. So a lot of people who listen to this podcast are probably pretty unfamiliar with what the term investment banking is and who an investment banker is, what they do. So can you kind of share a little bit about what an investment banker does and why the support is so vital to their growth or in a transition process too?
Yeah, it's a good question. So there's really a couple main reasons why investment banking exists. One is because it's to level the playing field between the capital sources or the buyers and a business owner. Oftentimes, a business owner is only going to raise capital one time in their lives, or they may only sell their business one time in their lives. And so it's something that they just don't have the expertise or experience doing. On the other side of most transactions is a buyer that is doing dozens, if not hundreds of transactions in their career. And so those people are very experienced at the nuances of how to buy. Sellers are often not experienced with that. And so therefore it helps to sort of level the playing field of having an expert that knows what they're doing with a counterparty that knows what they're doing. So that's one thing. The second reason, and maybe even more important than the first reason, is it's about maximizing value for a business owner. So if a business owner is looking to raise capital, oftentimes they can do that by themselves. It's not that there aren't people calling on them all the time, right? Saying, "Hey, I'd like to buy your business," or "Hey, I'd like to provide capital for your business," or banks calling on them saying, "Hey, I'd like to give you money in the form of a loan." But oftentimes competition is what creates the value for the business owner. So I'll use a recent example. We had a client that had been approached by a private equity backed company in Kansas City and said, "Hey, we'd like to buy your business." This was a Tulsa company. And so they provided financial statements to them, and the company said, "Hey, we'll pay you." I don't remember the exact number, somewhere close to $50 million for the business. And the business owner was pretty happy with that. Said, "Hey, this is a great outcome," and was sort of leaning towards moving forward with the deal. Well, we got involved and said, "Hey, for your business, that's not a market deal. Like, it's not a bad deal, but we don't think it's the best deal you're going to see." So he engaged us, and we went and we talked to about 150 prospective buyers for that particular company. We ultimately got, I think, 41 offers on that business. And the nearly $50 million offer that he was originally contemplating would have been the third lowest offer of all the 41 that he got. Mm-hmm. And so he ultimately transacted for a little over $100 million. So, and it's not that Infinity ourselves are the only ones that could have replicated that value. It's really just a business owner is in a way kind of playing Russian roulette if they're just taking one offer or two offers from people that are sort of inquiring on their business, because there's not really a good way to know what the market value of
Right.
the private company is
Right.
without creating that sort of competitive dynamic.
Right.
What?
Well,
So
Jacob and I were talking on a prior episode about this idea that creating great value is the accumulation of making great decisions, and that each decision has sort of three core components. Really clear priorities. What do you want as a business owner, and do you understand it well enough to make sure it's what you want and communicate it to your team? Do you have really good information to support the decision making process, and then do you have enough experience or expertise yourself or on your team to make great decisions? And you combine all of those and you can make a great decision. You can make it consistently. And what I feel like what I'm hearing you describe is what I think I see a lot from business owners is that they'll get an offer and they don't have, information about the marketplace. So they don't know what's possible. They don't know how to value their business. And they don't have experience or expertise. So they don't know, hey, here's how a sale process could look. Here's how you could create a market for your business that would get people to submit competitive bids in which they are driving the price up as opposed to you competing against one bidder, for example. And all of that can create a great deal of value. When you bring the right components to the table. But what a lot of people do is they settle for an inferior decision because they choose to just be satisfied with whatever information they have on the table as opposed to going out and getting more. And they choose not to bring an experienced partner like Infinity Capital to the table to help them get better information and make better decisions.
Well, and something, Chris, oh, go ahead.
Go ahead, Jake.
I was going to say something that you mentioned in a lot of conversations we have is really Infinity serves as the sports agent for the business owner. I mean, if you take it into, the sports metaphor is a lot of these, you have an all-star athlete who is really good at their skill, but they don't know how to market themselves out there and how to create that competitive landscape for all the say using the NFL, for all the NFL teams that are out there that want you need to create that competitive landscape for them. And I mean, talk a little bit about how you guys serve as that sports agent for these business owners as you represent them in the marketplace.
Yeah, it's a good question. I think to go along with what both of you said, I mean, there's really two main reasons why a business owner, when they get kind of an inbound offer from somebody, why they might be inclined to take it, like you were talking about, Sam. And one is this concept of bird in hand, right? Like, oh man, they made an offer. It's a pretty good offer. I don't know if I want to risk that by going to talk to other people. What happens if nobody else wants my business? The reality is there is a buyer for almost every business out there. It's just a matter of how hard you have to look for it. And if one person is interested, the odds are really good that there's a lot of other people that are interested. And so this idea of that nobody else will be interested is really a false narrative that I think a lot of people fall victim to. And so, Jake, that's one of the value of this sports agent concept is we know who the teams are, who the NFL teams are. We know how to get a hold of them, and we know what the market value of this business is, and what the attributes that are going to make a valuable business, right? The management team, the growth opportunities, the customer concentrations, the industry concentrations, like all these different factors. And so we can speak their language and we can negotiate a deal on their behalf. The second thing is why people oftentimes are willing to take this kind of like off-market approach. And Sam, sometimes they might not know that there's anybody there that can help them, or maybe they think, hey, maybe I should do this myself and not have to pay anybody a fee. The converse is some business owners think they know what market value is for their business, right? And so if you have a business that you're looking at selling, and you've talked to a bunch of buddies in the business, and they say, well, I sold for 5 times, or I sold for 6 times EBITDA. That's great, but oftentimes when you're selling a business, if you have a $3, $4, $5 million EBITDA business, and the market value is between a 5 and a 6 times EBITDA, let's say it's a $5 million EBITDA business. Well, the difference between one turn of EBITDA is $5 million, right? So why would I be willing to take a deal at $5 times EBITDA when there's a possibility of me getting 6 million or 6 times EBITDA and potentially giving up $5 million? Wouldn't I want to pay somebody a little bit of money to try to get that 6 times EBITDA offer? And so that's where I think a lot of people are sort of misled about the cost, if you will, of an investment bank or an advisor on a deal. is ultimately you'll get a lot more money than what you're actually going to pay them. And I
Right.
think if anybody were to talk to any of our clients or really any other investment bank's past clients, what they would say is these guys definitively got more money than I would have been able to get by myself if I
Right.
just called my two or three competitors or just answered that phone call
Right.
that I'm getting from people. So that's Jake,
Yeah. No.
how we're sort of being that sports agent for other business owners.
Yeah. No. I think that's an excellent illustration. I mean, we, as attorneys who bill by the hour, although I constantly revisit that model, we're constantly trying to think about how to help people understand that whether you're raising capital, whether you're selling a business, whether you're buying a business, this is a value creating event. And when you think about the resources that you apply to the event, whether that's, investment bankers, accountants, attorneys, whatever, your goal is to create the maximum net value that you can off of that opportunity. And when people approach it based on, which is often the case, people come in thinking about, hey, I'm trying to manage that cost of that resource that's going into it. We always want to get them to look at like, hey, what if you got somebody like Chris involved? And instead of that 5x, you get that 6x. That's going to pay for itself many times over. And so I love that you made that point because, I mean, especially when you're talking about like family businesses or really any other business, I mean, the difference between adding $5 million of proceeds, especially when, a lot of businesses are going to be paying taxes, they're going to be paying off debt, whatever else, adding that $5 million, I mean, that could be generationally transformative wealth for the ownership group. And I mean, huge. I mean, especially when you think about it, it's not just $5 million more. When you think about, I'm sure the percentage increase in that scenario of what somebody actually has left over after the deal, I bet it's a lot more significant than just, a 20% increase on, what they otherwise might have gotten had they accepted a 5x instead of working to get a 6x.
Yeah, and that example I gave of the business that almost transacted for 50 million and ultimately
Right.
transacted over 100 million, that one was it was over a 13 times multiple. So, business owners sometimes just don't have a good appreciation for what their value is.
Right.
Sometimes they think they do. Sometimes they're right. Sometimes they're wrong. And
Hmm.
so, it's just generally behooves business owners to sort of have a good idea. And this concept, guys, doesn't just apply with selling a business. It's the same process and the same logic of if I'm raising capital, right? If I need $5 million to make an acquisition, or I need $10 million to expand a manufacturing facility or something like that, if I just go talk to one or two groups, I'm capped at whatever their numbers are. But if I go talk to a few hundred different prospective people that want to invest in my
Hmm.
industry and my size and all those sort of things, then I can end up giving up the least amount of equity, or I can get the lowest cost debt, or some combination thereof. And so it applies there. It also applies in refinancing debt, right? There's you know lots of different lenders that would be interested in doing something, and the moment you start introducing this concept of competition, if you can get 25, 50 basis point lower on a loan because you created competition, or less covenants or other things that could be valuable, this sort of concept of competition just really adds value in really any aspect of the capital
Yeah.
raising process.
Right.
Well, Chris, something that I've found here in the Wichita area when I'm talking about investment banking, it's a lot of education, and people think, oh, well, I need to go to New York, LA, Boston, wherever, a major city in order to access an investment banker, banking professional. But it's also like, well, I'm too small for an investment banker, and I think so. Like, talk a little bit on that about being in the Midwest, focusing on the Midwest companies, and really how when a person's starting to evaluate whether it be raising capital, selling, but like when do they know that they need to start engaging with an investment banker and like a size parameter? Because a lot of people think, oh, I need to be doing $50 million in top line revenue before I can be talking to anybody about this kind of thing. But that's complete opposite of how Infinity looks at engaging with these business owners.
Yeah, it's a good question. So, what I would say generally, and these are broad brush strokes, but most businesses that have, 500,000 of EBITDA or more are interesting acquisition targets for private equity backed companies, public companies, other folks. And so the entry point for when you might be able to get an investment banker involved, or somebody that can sort of actively go manage the sale of your business, sort of starts at that lower level. And so that could be, $3, $4, $5 million of revenue. It doesn't have to be a huge business. Now, to be what we would call a platform business, where a financial buyer, whether it's a family office or private equity firm or whatever, oftentimes for those institutional investors, their starting point will be closer to 2 million of EBITDA or up. And so that creates sort of an exponential amount of opportunities for that business. So they don't have to just sell to a competitor or sell to somebody in their industry or whatever. Now they can be, okay, an investor could come in and say, I'm going to buy a controlling stake in the business, and I'm going to invest behind the management team to take this to the next level. And then we're going to make acquisitions, and you guys are going to sort of manage those acquisitions. We're going to expand geographically or organically, but you guys are in charge of all that. We're just sort of supercharging it with the capital that we have. So that typical entry point is about 2 million of EBITDA. But businesses vary in what their margin profile is. So we've had clients that are at 2 million of EBITDA that, were 6, 7 million of revenue. And we've had others that, you have to be 20 plus million of revenue to be able to get to 2 million of EBITDA. So kind of depends on the industry, but you're absolutely right that the entry points for a lot of these services, or the interest level from institutional investors or public companies that are acquiring, or large private companies that are interested in acquiring businesses, start at much lower levels than what, the people in New York, oftentimes, or in some of these bigger markets. Yeah, their minimums might be, 30, 40, 50 million of EBITDA, which is actually above where we would sort of, cap out, because we don't spend our time dealing with those types of companies. So we don't have as many relationships with large institutional investors or buyers of those types of businesses. So we kind of cap out and say that's for those groups to handle. But for smaller investment banks, for smaller companies, more boutique investment banks like us, across the region and other places, would be a much better fit for helping these companies that are smaller get capital that they need.
Yeah. No, that's terrific. One thing I'm curious about from your perspective is the value of timeline for folks. Like you've talked about, the change in valuation, based on, financial performance, et cetera. When you have somebody come to you that is in a position that, hey, I've got to sell, I just got a cancer diagnosis, whatever that looks like, or, hey, this is just, we've got to sell. We don't have any more time, versus somebody that comes with a more, kind of open-ended, flexible, timeline. How does that impact the valuation that you can help somebody achieve, on an exit, for example?
Yeah, it's a great question. I mean, time does impact value. It absolutely does. If you have a rushed process for some reason, it is absolutely going to affect value for a business owner. So if it's hey, I got to sell in 3 months, or we get this sometimes. I mean, we got calls in October. Hey, I'd like to sell by the end of the year. I don't know what's going to happen with the election, and
right.
I just want to protect myself. Anytime you try to do a rush transaction, you aren't able to get a buyer pool, or a significant buyer pool. And when you have to convey that you're sort of under duress or you're in a hurry or whatever, buyers will inherently hear that, and the values that they come back with will just be lower. Because if they're having a rush, it's like, well, what risks am I not understanding, or why are they, what am I undertaking that I wouldn't otherwise be able to identify or scrutinize in a normal diligence process? So it does impact value. A typical timeline, if somebody's wanting to quote unquote maximize value, is going to take about 6 months. And the way it typically works is about the first 45 days or so is kind of this underwriting and material preparation phase, right? Somebody's putting together a historical financial model. They're building a forecast model as well. They're analyzing the operational metrics of the company, things like, sales by product line, or margin by customer, or all these different things to be able to answer questions that are inevitably going to get asked. They're putting together what's called a SIM, or it's really a fancy word for a PowerPoint presentation of 40, 50 slides that talks about the company, the regulatory environment they're in, the competitors, the management team, growth opportunities, historical, financial performance trends, things like that. And so that first 45 days is all about the advisor learning about the company, so that when they go to market, which is the second phase, they can answer all these questions about the business without the business owner or executives having to be on all these phone calls and, basically spending their 40 hours a week doing nothing but answering questions. And so that first 45 days is kind of that prep. The next 30 days is about how long a business is typically, quote unquote, at market. And so this information is being shared with buyers after they've signed a non-disclosure agreement, and they're evaluating the opportunity, asking questions, doing all that. And then at the end of that 30 days, they have to submit a non-binding indication of interest saying, hey, I'm interested in this business. Sometimes it's a range of values. I'd pay between this and this. I'd like to buy 100%, or I'd like to buy 80%. I'd like the seller to roll over some equity or take a promissory note, or all these different things. So you aggregate all these offers, and then the client and the advisor sit down and say, hey, which of these do we like, and which do we want to invite to kind of the next phase of the process? And the next phase of the process, which is another 30 days, give or take, is meeting with the management team and seeing the business and getting familiar with them. And and secondarily, the business owner has the opportunity to meet the prospective acquirers or capital sources and figure out who culturally meets their criteria, who's shared or has alignment with the vision that they have, and helping them execute that. Because again, it's a dating process. The worst thing you could possibly do is get the capital that you need, or sell the business to somebody that isn't really a good cultural fit with what you're wanting to accomplish. So the first 45 days, then the next is the prep phase, then 30 days is marketing phase, and the next 30 days is kind of this, it's called management meetings, but called this courtship phase. And then at the end of that, they all have to submit another bid for the company in the form of a non-binding, typically letter of intent. And at this point, they're saying, this is the dollar amount I'm willing to buy the company at. Here's all the details, not all the details, but all of the really important transaction-related details get fleshed out in that document. And the two parties sign it, and it kicks off the sort of final phase, which is the due diligence and the closing phase, and legal. And that process, I mean, Sam, you know this better than anyone, but it can be as short as 45 days, and it can be as long as 90 days. I would say most deals probably take 75, 60 to 90 days probably. It's rare that a seller has all their information pulled together in a way to be super efficient with the buyer's process. And so it just takes a little bit of time to draft up all the documents and to provide all the documents for somebody to perform their adequate due diligence on. But that process, again, even going efficiently through it, just ends up taking about 6 months, plus or minus a month or so.
Yeah.
So that's my experience.
Jake and Sam here.
Thank you for joining us. If you find this content helpful, please like, subscribe, share it with a friend, and especially leave us a 5-star review on Spotify or iTunes. It really helps us out a lot.
Yeah, 1 star, it's on Sam.
Yeah, it's definitely on me. No, that's helpful. Sorry, go ahead, Jake.
And Chris, kind of going back to that original valuation that you all do to really start the relationship with the business owner, what are some key, I mean, it differs by industry, by business, but what are some of those key attributes or things you're looking for in a business to know that, hey, there is some opportunity for someone to buy this business or invest in this business? I mean, there are some key things you guys are looking for when you're going through that evaluation.
Yeah, what I would say is, like, if there's like 2 columns, right? This is like most desirable, least desirable, right? Because and you may have some stuff in the most desirable bucket and some stuff in the least desirable bucket. Doesn't mean that if you have one thing in the least desirable bucket, oh my gosh, my business is sellable. But for example, buyers want to know what industries you're selling into, right? So if you have a business and you're only selling into the oil and gas industry, which is typically viewed as a commodity, very cyclical business, that there's still a buyer for that, but the multiple that you're going to get is going to be far lower than if you're in the same industry and you're selling to a medical end market or in aerospace or some of these other end markets that the buyers typically view as a little bit more attractive than the oil and gas. So industry and markets is an important factor for what people are willing to pay, even within the same industry. Customer concentrations is another one, right? So if I'm a buyer of a company, and Jake, your business, 50% of your revenue comes from one customer, that's a lot of risk for me to take on. If something happens after closing, whether I control it or they sell to somebody else and they have a corporate supply chain group that changes what they're doing, and now my business goes away, that's a huge chunk of my revenue that's gone. And so I'm going to pay less for your business, Jake, than if Sam owns a business and his number one customer only accounts for 10% of his revenue. So if I lose, Sam's top customer, I can replace a 10% customer, or I can at least not, go out of business. But I'm just taking a lot more risk, and so therefore I can pay more for Sam's business and Jake's business simply because of that. So that's another factor. Other things that are really important, management team is always important. And sometimes the business owner wants to sort of quickly transition out of the business after they sell. That's usually not an issue if you're selling to somebody in your industry, or if you have a really strong management team in place. And sometimes both are required. But other times, a business owner is the same person that is doing all the operations. They're doing all the sales. They're doing all the accounting, finance. They're doing sort of everything. And without a management team in place doing some of those things, when they go to sell, the buyer oftentimes will require them to stick around for a longer duration after the closing. And they will probably pay a lower overall value for that business because now they don't have a team. If something happened to that business owner, for whatever reason, they got too much money at closing and they became demotivated, or they, got cancer or something else happened to them, that's a lot of risk for the business, the buyer. And so therefore they're going to sort of, that will pay accordingly. There's a number of other things that are going to impact, specific industries. Some industries are more project-based versus reoccurring or recurring. So if I have a business and I'm getting every one of my clients just pays me a monthly reoccurring, fee to manage or outsource something, that's a lot more attractive of a business model to most investors than a business where I might be a general contractor and I've got 5 or 6 projects a year and they're $40-50 million each. And I've got to bid for all my work and my margins are really thin. That project-based nature of the work that the general contractor does is far less attractive and therefore going to get a far lower multiple than an industry where it's sort of more reoccurring, or, there's demand every few years. Maybe it's plant turnarounds happen and therefore every steel mill has to get plant turnaround every couple of years. And so that would be reoccurring, even though it's not recurring. And so that would be sort of pretty valuable as well. So again, there's a lot of factors. It varies by industry. But those are some of the factors. How concentrated is my revenue and markets, customer concentrations, how much capital expenditures do I have, management team, my revenue and growth profile, am I growing or shrinking? All those sort of things will impact value ultimately for a business.
No, that's really helpful. I mean, when we talk to a lot of first-time buyers, first-time sellers, we're a lot of times telling them, hey, think about, regardless of which size of the deal you're on, how predictably the value can be transferred from the seller to the buyer. Because a lot of times there's value that the seller might hold in their hands that they're going to give up that isn't going to predictably transfer over to the buyer, whether that's, hey, I've got all the know-how in my head and I've got all the relationships, and I don't have a management team there, and whatever else that might be. And there's just a lot of value that can leak out as it's going across the table. And what we see a lot of times is that price is more about the value that's received by the buyer than it is about the value that's given up by the seller. And then when we get folks to kind of think about it in that way, they, have better expectations, they make better plans for the business, they, structure better deals in the process. But those are really helpful. Those are really helpful points there, Chris. One follow-up question I had for you is, when you're doing that initial valuation with folks and they come to you with, hey, here's my goals, here's where I want to be, and I'm flexible on timeline. Maybe it's, hey, I'd like to sell now if the value is right, but I'm open to, holding on to this for another couple of years. How can that help you, that initial evaluation, as you're looking at customer concentration, looking at their team, looking at all of these value drivers for their business, give them input on, hey, if you can change these things, and keep growing the business, we can help your valuation go from here to here. How do those conversations come together for folks?
Yeah, those happen all the time. I mean, I had one last week where we basically said that and said, hey, there's a market for your business. Here's what we think that market would be. And again, we're going to go to market, and the market's going to kind of speak as to what value is. And sometimes we're low, right? And the market exceeds our expectations. But we want to be realistic with a business owner, because as an investment banker, we get paid if and when a deal transacts, right? So we don't want to set expectations with a business owner that your business is going to sell for this huge number, and then ultimately we spend a bunch of time and effort and then come back and ultimately can't deliver on that value. So we're realistic on the front end, saying, hey, here's what the value is, and have a high degree of success with at least meeting, if not exceeding, that value. So that's the first part of the conversation. And the second part of the conversation is, we're sort of indifferent to timing. Whether you want to do something now, great, we'd be happy to help you. But if you were comfortable continuing to operate the business, here's like 4 or 5 things that you could do that would really make a material difference in the value of the business over the next few years. So those conversations happen all the time. I can think of a precision machining business where we had that exact conversation last week, and it was like, hey, we can go sell you for, call it $10 million. There's a bunch of people who'd be really interested, but you have a pretty significant industry concentration to 2 different industries, and you have additional value that you can create as you continue to build out the capacity that you have. So here's what the value is today, but you've told us what you think you can be at in 2 years. Here's what the value looks like in 2 years. If you really think that's realistic, you can almost double the value of your business in the next 2 years. And so ultimately, is it worth it to you to hold the business? And, if you can make another $5 million each year for the next 2 years before you sell, because that's how, doubling the value of the business from 10 to 20 is going to sort of translate. Oh, and by the way, in the meantime, you get the cash flow that's generated in year 1 and year 2 from the business. So it's actually more than $10 million of value. So we have those conversations all the time with business owners to help them decide. And sometimes they're just not ready. They're curious, but not ready to actually do anything. And so then we'll give them some guidance on, hey, if you're not going to transact for the next 2 years, why not get this? The way you're managing inventory is not per GAAP. And so why not spend some time hiring a consultant or somebody to come in to help you get that ready, so that when you do transact, there's not a lot of risk of, well, you think your EBITDA is $3 million, and then you go, and then a buyer sort of hires a third-party advisor to come in and finds out that, well, because your revenue recognition is wrong, or because the way you're booking inventory is wrong, or some of these other things, it turns out that you're really only $2.5 million of EBITDA, and the purchase price ends up being slightly lower than what you had hoped for. So trying to get them to sort of address those things on the front end, Sam, is critically important if they can, or if they have time before they're ready to transact. If they don't have time before they're ready to transact, then that's where we will sometimes hire a third party our client will hire a third party kind of alongside of us to do some of that cleanup work in the first 6 weeks of the transaction. While we're putting our materials together, they're sort of doing some of this accounting cleanup stuff. So it can be done either way, but if you got the timeline to do it, you might as well kind of get your house in order, before you're going to put it at the open house.
Yeah, no, that's great. That just, I think, really reinforces the point for all of our listeners that time is your friend. When you give yourself time and you get the right team involved early enough in the process, they can help you create just dramatically more value. That scenario that you just described of, hey, you give me enough lead time and you take good advice from me, you can go from being maybe a $10 million company to, continuing to get cash flows out for the next couple of years, and maybe being a $20 million company. For a lot of business owners, that's a game changer. That's huge. That's huge. And over a relatively small period of time. But one that requires that intentionality and that planning to say, hey, I'm going to go find Chris. I'm going to go build that right team, and make sure that I'm following that advice, so that I'm actually in a position as a business owner to, apply that wisdom to my business and really drive value. Jacob, I think I cut you off.
It was something kind of there was a couple things there, but one thing you mentioned, there's always a buyer that's out there, and what things that I find valuable with Infinity is that buyer universe that you all have spent a lot of time on building that. I just witnessed this the other day in a conversation with a business owner that they had been approached by somebody to acquire them, and they were didn't know what the process looked like, but they wanted to know, like, what are other companies out there that are, exiting in our space. And so, that's one thing that Infinity has, is that buyer universe. So there's other companies that have transacted in that space or whatever industry you're in. And what value Infinity brings is experience, and also that ability to call that private equity group that exited the company that's in, Colorado, for an example, and asking them about, hey, what were you looking for? What were you doing? And can really have that conversation with people, all confidential, of course, but you're able to bring value back to the business owner to say, hey, this is what's going on in your industry right now. This is what's happening. These are the type of transactions that are going on, and really give them options versus just taking that first phone call that somebody wants to buy the business, say, yep, that sounds good, and they go for it. You guys provide every aspect of that with that buyer universe.
Yeah, one thing I would, along those lines, I would point out. I mean, a lot of people are familiar with kind of a valuation that an accounting firm does, right? Accounting firm comes and looks at your business and applies different approaches and ultimately says, here's what the value of the business is. And that's usually done for estate planning purposes or for litigation purposes or different things like that. But the reality is, most of the transactions for these private businesses, like 90% of them, are private data. There's nothing available. So there are some transactions that are shared that are public comps or other things. Public companies buying smaller businesses, and so some of that can kind of make its way in. But ultimately, the CPA firms really don't have a lot of private data to go off of that they can point to and source their data and say, this is the transaction that I'm attaching your value to. So what we find very often is the market value of a business is actually well in excess of what a CPA firm can or would put their stamp of valuation behind, because we can pick up the phone, like you said, Jake, us or any other investment bank. We can call any other investment bank that sold a deal, or we can call a private equity firm that did a transaction, and we can have that conversation with them. Now, we can't source that in a document the way that an accounting firm needs to be able to stand behind a valuation. But yeah, in 4 or 5 phone calls, I can call and get data points on almost any industry out there and come back and say, hey, this sort of buoys. I initially told you I thought your business was sort of a 7 to 8 times multiple, but I just had 4 conversations with people that are invested in the space, and they're buying companies similar to yours in scale at 9 to 10. And so actually the valuation probably is higher than what I originally told you. So that sort of collaborative environment in the private equity, investment banking kind of deal world allows us to have a really good pulse on what, true value could be. Ultimately, it's going to vary based on a ton of factors, because in a 10-minute phone call, I can't share all the nuances of every business with a buyer for them to pin it down exactly. But we all understand the world, pretty similarly, and how buyers are going to think about it. And everybody's really willing to collaborate because they want to see those deals. They're like, hey, if we scratch the back of these investment bankers, when they come to market on a deal in this industry we know well, they're going to send it to us. We're going to make sure we get to see that deal. So anyway, I think that's something that's helpful. One other thing, Sam, I wanted to touch on that you mentioned is sort of this value creation. One thing I think most business owners, if they have the couple of years of time before they transact, or even if they have a few months before they transact, one of the things they don't spend enough time on is kind of the tax and estate planning side of things, right? So we are execution focused people as an investment bank, right? But tax and estate planning attorneys and tax and estate planning folks at CPA firms are really valuable members of the deal team, like you talked about, because if we're going to go transact, understanding what a business owner's goals are and who's going to ultimately end up with the money from the liquidity event is really important, because there's different gifting that can happen. There's different structuring things that can happen to sort of maximize their after-tax proceeds. Far too often do we have business owners come in and say, I got to sell my business for $25 million. And you're like, why? And they're like, well, I did my back of the napkin math, and by the time I sell for $25 million and pay 40% taxes on the deal, it leaves this much, and that's about how much I feel like I need to have to be able to make it the rest of my life. And it's way more nuanced than that, right? There's a way to do a deal at probably $20 million that could mirror a $25 million deal structured in the wrong way and not protected, where you ultimately end up with more proceeds on the $20 million than the 25. So it really should be focused on kind of an after-tax proceeds, and a lot of that can't happen without getting the right advisors involved kind of at an early stage.
When I
Yeah.
think kind of on the advisor side of it, like there's a lot more parties involved than just the investment banker, the company, and the buyer of that company. I mean, you have accountants, legal, banking, wealth managers. I mean, how do you all engage with all of the advisors that are also working with that business owner, and also on the flip side of the buyer of the business, who's working with them too as well. So how do you all engage with all those advisors that are counseling them?
Yeah, so typically an investment banker is going to be your sort of deal quarterback. There are times where, Sam, I'm sure there's not an investment banker involved in the deal, and you
Hmm.
are the deal quarterback. But when there's a whole team of people, an attorney, an investment banker, an accountant that knows the business really well, and then maybe a tax advisor as well. There could be others involved also, insurance and others. But when there's a whole team like that, the investment banker typically will run quarterback because they have been involved sort of from the get go, helping hear the market feedback. They're helping with once it gets to legal, they're helping coordinate and share information with the attorneys about things they learned along the way to make sure the reps and warranties are properly made, and any exclusions or caveats to those are notated in the documents. Schedules are put together accurately, things like that. Same thing on the with the tax advisors. Getting them involved early on and saying, hey, are there any goals or objectives or things that you guys have that you want to do sort of either before the transaction or sort of after the transaction? Knowing those up front allows tax counsel and legal counsel to be able to structure the transaction correctly. And so it's really just a matter of kind of making sure that all the parties are sort of involved in the right steps of the process, and making sure that everybody's kind of clued into what's happening, so you don't get to the closing table or a couple days before closing and something pops up and it's like, well, why didn't we think of this? Why don't we push it 2 days and put it into the next tax year as opposed to this tax year for XYZ reasons? Or conversely, why didn't we do it a little bit faster? Why didn't we structure it this way or that way? So there's a lot of nuance to it, but it's really about making sure that the whole team is involved and included and updated on what's going on.
Yeah. No, that's terrific. That's terrific. Chris, I'm curious for your feedback on something. I mean, your firm has a big focus here on the Midwest. I mean, I love working with clients here in the Midwest, but why has that been a focus for you all, and what is it that you like about that direction for your firm?
Great question. So we have kind of the exact opposite thesis of most investment banks. If you look at most investment banks, they want to congregate in large metro areas. So Dallas, Chicago, New York, LA, San Francisco, places like that. And so for us, we want to be local boots on the ground for business owners in every market that we're in. So it's why we brought on Jake. It's why we're moving some people out to Tulsa, and we want to be in other markets. Springfield, Missouri, Amarillo, Texas. Many of these markets that are great. Kansas City, others, great markets, but they're underserved from an investment banking perspective. The business owner can't schedule a meeting the next day in their office with somebody if they have questions about the sale of their business or something like that. They don't want to have to wait for somebody to fly in from Chicago in 3 weeks to be able to make a decision about moving forward with this off-market offer they got from a buyer or something like that. So, and also a lot of people in the Midwest, they just want to do business with people locally. They trust and like people that they can walk down the street and say hi to, or they know or have heard of reputationally and things like that, as opposed to just hearing about this big firm in Chicago that sort of flies in to sort of provide services. So that's really important to us. And so being boots on the ground in all the markets that we're sort of actively pursuing and targeting, is our sort of growth strategy and plan over the next several years. So we expect to be in multiple of these kind of secondary and tertiary markets, kind of like Oklahoma City is, and being that local boots on the ground resource for them.
No, that's terrific. That's terrific. I'm curious for your take on something, so, when we talk to folks about, hey, maybe you should think about working with an investment banker to sell your business, for example, sometimes we'll hear a variation of, oh, well, they're just going to go shop me to private equity, and I don't want to sell to private equity because I'm worried about, they're just going to take my customer list and leave everything else behind. And, what's that going to do to my employees, my community? Is that, I don't feel like that's an accurate representation of what the options are when you go to an investment banker, but can you speak to that concern specifically?
Yeah, it's a valid concern, right? There are I I think the last I heard there's over 10,000 different private equity firms. Private
Mm,
equity as a class is broader than what people are thinking of, just like a private equity firm, right? It's
hmm.
family offices. It's a
Sure.
family that's made a bunch of money in a certain industry. They sold a company. They owned a bunch of real estate, sold it, whatever, and they've got money to invest. So sometimes it's a family. Sometimes it is a formal private equity firm. Sometimes it's a Native American tribe. Sometimes it's an insurance company, or there's a lot of different things that would fall into this sort of private equity bucket. Um, but what I would tell you, after having done so many deals and interact with so many different counterparties over the years, they're not. There are very few private equity firms that are exactly alike, right?
Hmm.
Some people focus in a certain industry. Some people focus on a certain size. Some people focus on types of capital they provide, and in those respects, they can be similar. But there are some firms that are very hands off. They are, hey, we've got capital that we've raised, and the way our mandate works is we want to find good management teams that we can invest money behind. And we don't have any expertise. We don't have any resources to like do anything. It's like we find the perfect management team, we give them capital, we buy out the owner, whatever the case may be. We let them just continue to operate the business. And that's really what the relationship looks like. And some of those management teams are fantastic and knock it out of the park. There are other firms where they say, no, 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 we're not passive investors. We are active investors. So we're going to provide the money, and then we're going to grab the joystick and we're going to start, they'll call it a value creation plan, but we'll come up with a value creation plan with the management team, and we're going to like have them go in different directions and sort of do different things, acquire companies, do all these sort of things, and make changes to the business. And that's how we'll drive value. But we don't do anything passive. We are an active management group. You then have other people that might say, hey, we're not active, but we have people that we know or are in our network from a specific industry. So we're going to target utility company, people that provide services to utility companies. Because we've got 3 or 4 people that we know that used to be on boards of utility companies or senior executives or whatever, and they have relationships that they can use to add value to a particular company. If a company's selling into those, they might be able to add introductions for 3 or 4 companies, or they might be able to provide strategic advice as people are thinking about, hey, here's what my growth plan is. They could probably say, hey, that will probably work or won't work. But they're not necessarily actively involved. They just kind of sit on the board and add value, and don't have an active role in the day to day and still rely on the management team. And then you have another group of people where they don't have, they're not necessarily active, they're not necessarily passive, but they have a bunch of what they would call resources available for the business that they invest in. So they might have a finance person that's really knowledgeable about anything and everything accounting and finance. They might have another one that's really knowledgeable about IT. So if you're doing an integration of an ERP system or a conversion of a CRM or something else, they have this resource that they can have
Hmm.
come to the company and help them out. They might have an HR or recruiter on staff that sort of helps supplement the HR and recruiting capabilities of what the companies that they own have. Could have a sales executive or a supply chain executive or some of these other people. So they're not, again, grabbing the joystick. They're sort of supplementary resource that are available if the business owner requests them. So everybody's really different. And to your point, it's a matter of finding that fit. So when we go
Hmm.
to market, when we initially start, we'll work with the business owner to build that buyer list of like, hey, who you want to include, who do you not want to include. Make sure we're not including competitors that they don't want to see information, or private equity firms that won't meet their specific criteria. But once we get the offers back, that's where those management meetings are so critical, Sam. When you meet with 3, 5, sometimes as many as even 7 to 10 prospective buyers for your business, you get a really good appreciation when you meet with these people for 3 or 4 hours and you tour your facility with them of how they're going to be as a partner. Are they
Hmm.
aligned with the strategy you have, or do they think they know more than you and they've got their own strategy? Do they have resources that they can bring to the table that add value to you guys, or not? Or are they passive and they're just relying on the management team, which gives you more flexibility as a management team? So it's just finding that right fit of who the group is. And a lot of times you're going to multiple groups. You're going to people that will invest minority capital in the business that are almost inherently passive. You'll go to people that are looking to provide majority capital, and then you're also looking at people that are strategic buyers. And you might get offers or indications of interest from all of those groups. And so you are able to sort of compare and contrast what the different structure types are with the different groups that you have, and ultimately make the best decision for the business owner possible.
No, that's terrific. Jake, you get the last question, man.
Last question. All right. Well,
knock it out of the park.
Well, I would love to jump into some success stories, but I know we're limited on time. But, kind of like, what advice would you give to a business owner considering, a sell or partnering with an investment banker, exploring options for growth? Like, what's that advice that you'd give to, say me as a business owner? What advice would you give me as I'm kind of thinking about my next options for my business?
Yeah, it's a good question. I think my first advice would, I think I would always be open-minded to knowing what my business is worth and what I can do to sort of add value. Even if a business owner has no plans on ever transitioning their business, you never know when the right opportunity will pop up, or the industry might make a shift that's not necessarily favorable to what you want to do long term, or something happens to you or the management team or other things that might shift your thinking. And so too often we hear people that are like, well, I've never really thought I was going to sell my business, and now I'm kind of in that position where I need to or want to, and I haven't really, been focused on that or thinking about that. So I think being aware and just being constantly curious about the how, the why, the what, and what's important, and aligning your business to try to maximize value, even if you won't ever actually maximize value. Typically, those same things that buyers look for are good business practices. Having a diversified revenue stream, having different end markets, having low amounts of capex, trying to have more reoccurring revenue streams, as opposed to having lots of heavy project-based revenue streams. Things like that generally are just good business principles for the business owner, regardless. And so, being curious would be really helpful. I also think always paying attention to the numbers. The numbers tell a story about a business. A lot of people sort of neglect the numbers, the financial statements, things like that, don't really understand them or don't really care about them, as long as they're making a distribution each year, or as long as they're sort of minimizing the tax they have to pay on the same each year, they're sort of happy. But really understanding things, because far too often when we get engaged by a client and we start asking questions about, well, why is this happening, or why is that happening? Why is the margin going down? They don't know. And so if they had known 2 or 3 years ago, as they were operating the business, why those things were happening, they could have impacted potentially what the decline in the EBITDA margin, or the decline in the gross margins, or other things like that. So just being curious about what's going on in the business, and understanding that ultimately the financial statements and all that is going to be a reflection of your performance. It's almost like your scorecard, along with some of those key performance indicators we talked about earlier, if and when you do go to exit the business. So pay attention to them and learn, ask questions of your accountant and other advisors to make sure you understand what's happening, and you can sort of make positive change in the business, while you hold it.
Yeah, that's something that we chatted with in a previous episode is asking for advice, but accepting that feedback and applying it. And I think that I love that, stay curious and stay aware, and your numbers tell a story. I mean, I think that's so many times we get caught up in working in the business, but not necessarily on the business. And so that's really sound advice. So thanks so much, Chris. Did you want to close it out, Sam?
Yeah. Hey, Chris, thank you so much for joining us. A lot of folks that are listening today are a lot better off for having more information to better make decisions about their business and about their exit process or their acquisition process. And we really appreciate you sharing your experience and your wisdom with us. To all of our listeners, be sure to stay curious, stay alert, pay attention to what's going on in your business, build your team, and give yourself time. Don't wait until the last minute to do these things. The more time you give yourself, the more options you have. The more options, the more value you can create. Thank you all for joining us, and please tune in next time. Same bat channel, same bat streaming platform, whatever. So thank you all. Have a great day.
Thanks, Chris.
Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.